Well, welcome to Tufts, everybody, and thank you for coming to the Freeman lecture. In a moment, we're going to have Eric Adams come up and introduce the Freeman lecture, and then Kurt will introduce Greg, and then Greg will about modern finance. So Eric, please.
Oh, well, thank you. It's good to see a healthy crowd out in the audience here. As most of you know, this lecture is brought to you on an annual basis, courtesy of the John Freeman Fund, and it was based on a bequest that was now nearly 100 years ago, 1925, to honor John Freeman. He was a world-renowned hydraulic engineer, was responsible for a number of large projects in water supply systems like San Francisco and New York. And locally, he was responsible for much of the design of the original Charles River Dam. And so when he died, he had a bequest. And out of that money, we have annually for the past 50 or so years had this Freeman lecture. And we hope to continue this in the future. If any of you have ideas as to who might be good speakers on hydraulics in general or hydrology and water resources, we'd be happy to hear it. And there's also some funding available for fellowships for students, specifically young engineers, students and young engineers, defined loosely maybe as under 35 or so, dealing with some aspect of hydraulics or hydrology. And if people are interested or know somebody who might be interested, if you could contact one of the members of the Freeman Committee, that would be great. I think that's about all I want to say.
Thank you, Eric.
All right, thank you everyone for coming tonight. I'm responsible partial or mostly for bringing Greg here tonight. Greg he's the William R. Kenan Distinguished Professor in the Department of Environmental Sciences and Engineering at UNC. I think that's probably the only engineering department at UNC.
Biomedical engineering.
Oh, that's biomedical, all right. And he's also the director of the Center on Financial Risk and Environmental Systems. And you'll hear about his work tonight, so I won't go on about that. But I met Greg mostly through AWSP, and he was, that's the Association of Environmental Engineering Professors and Scientists and Professors. And he was president of that organization for a number of years on the board, and was instrumental in many activities that they had going. And Greg got his PhD from Rice, so that's my other connection. I know a lot of people at Rice, and his BS at Hopkins. So without further ado, Greg, please go ahead and teach us all you know.
Thanks, Kurt. I appreciate it. Thanks to the Boston Society of Civil Engineers for hosting this, and thanks to the Freeman Committee for inviting me up to be a part of this event. So I'm going to talk to you a little bit about this issue of financial risk and how environmental systems, environmental processes can be directly related to financial risk in a lot of ways, although it's usually not the only factor. It's usually a strong contributing factor in the cases in which we work. And so since this is probably a topic a lot of people don't spend time on, I'm going to give you a little bit of background that hopefully makes clear why we do what we do. So the motivating force is that highly variable revenues and costs can be very disruptive. So this is actually a time series of 65 years of annual revenues for a small hydropower production facility. And what you see is that they bounce around quite a bit, right? Everywhere from about 800,000 at a low point up to around 15 million. And so while this is a small facility, this sort of variability, these wild fluctuation can be very disruptive, right? Make it difficult for you to plan, make it difficult for you to be assured that you'll be able to meet your firm obligations, right? Make it difficult for creditors, so people who lend you money to be confident that they're going to be paid back. And so if you think about hydropower, well, it's probably clear that reservoir inflows are highly correlated with generation, right? So that's an important factor to consider. And as a matter of fact, the match is just about 1-to-1. But if we're interested in not just generation, but we're interested in the revenues that come about as a result of that generation, the picture isn't so clear. So you see that inflows can be high in some periods and revenues low, and that's because you're usually selling electricity into some sort of power market, right? So there's more things to consider here. And so when we think about these problems, we usually start with the natural system, thinking about stream flow, temperature, wind, solar irradiance, whatever factors are at play in the situation that are of most interest to us. And here we focus a lot on the historic time series, but increasingly we're looking to generate synthetic time series as well. And so we take advantage of the kinds of stochastic hydrology techniques that like Professor Vogel works on. And so while we hopefully contribute a little bit in those areas, we mostly make use of the existing knowledge. And that's really important when we answer this first question, which is how much water and power is naturally available. So, but that's not the only question that has relevance in most of these situations. So if I were to put seasonal inflows and seasonal revenues on two axes, you'll see that there's a relationship there. But clearly we're missing more, right, than a little bit here. R squared of 0.48. So yes, there's a relationship between revenues and inflows, but it doesn't tell the whole story. To understand the story, we've got to add a little bit more. So we have to add an understanding of the engineered system. So the dams, reservoirs, how they're operated, the electric power systems into which the energy flows. And there we can answer the question, how much water and power is actually delivered? And then finally, we've got the institutional structure. So the economic and financial systems, fuel prices that dictate a lot when we talk about natural gas, the price of electricity, the electricity markets, environmental rules and so forth that filter all of this input from the first two systems. And so here we can answer, to whom is that electricity delivered, for what purpose and at what value? And when we build these sort of integrated systems, then we have a much better understanding of financial risk. And so to harken back to this example here, so this was work done by Jordan Kern, now a faculty member at NC State as a part of his dissertation. And so when he looked at this system, he said, well, we clearly don't understand everything here. So he dug a little deeper and he found that hydropower in this part of the country is used almost exclusively for peaking. And so when hydropower is not available, the only real alternative is natural gas-based generation. And the price of natural gas-based generation is tightly tied to the price of natural gas. So he developed an index that included both inflows and natural gas price. And there we have an excellent agreement, right, between seasonal revenues and the index. And so what does this do for us? It gives us a good sense that we have a better feel for the underlying causes of the risk. And it also gives us an ability to build some sort of risk management strategy or new risk management product that will be effective. And so if I take a time series that looks like this, and I apply some sort of simple index insurance, which we'll talk a bit more about later, with some management, I can raise the floor, the revenue floor from about 800,000 to about 2.5 million here. That may be a level at which I'm confident that I can meet my firm obligations, I can pay my debts and so forth. And this doesn't come for free, of course. If I'm looking to develop some risk management strategies, there's going to be a cost. And so we'll earn a little bit less in the wet years in order to protect ourselves against the dry years. So a very simple illustration. We'll get into more complex things later, but I hope this gives you a feel for the kinds of things that my group does. So why do we worry about financial risk? Well, there are some impacts that we'd like to avoid, right? The worst manifestation being default or bankruptcy. If you're a publicly traded firm or a privately held firm, you're going to have a lower valuation if you have wildly fluctuating costs and revenues. There's a penalty associated with that. And then there's this issue of financing. So everybody borrows money. Very rarely do people pay cash for things. And so when you borrow large sums of money, the rates of financing, the interest rates that you pay become very important. And so whether you borrow via loans or you borrow via the bond market, this is a critical issue. And I find that it's more important than a lot of engineers and scientists realize. There's a reason that they divide percentage points into hundredths of a point when they begin to talk about financing. When you borrow tens, hundreds of millions, billions of dollars, those make a difference. So to give you a little bit more of a sense, some of you may recognize this character, James Carville, the Raging Cajun. He was a close advisor to President Clinton. And he was continually frustrated with actions that he wanted to take by the admonition that the bond market would react adversely. And so he said that when he came back in his next life, he wanted to come back as the bond market because you could intimidate everybody. So he's talking about the sovereign bond market here, which is a little bit different, but nonetheless, the point is well taken. All right, so the other reason that we're interested in understanding these environmental financial risks is that they're growing. So here we're talking about droughts, wildfires, floods, extreme temperatures, severe storms, and so forth. And we see a clear trend here, and these are in real dollars. This comes about as a result of a couple of factors. One, we have increasing wealth or assets at risk, right? All you have to do is look at coastal development in North Carolina in 1980 versus now, right? There's a lot more wealth at risk, but there's also greater natural variability as a result of climate change that seems to be having an impact here. And so this affects a lot of sectors of the economy, a lot of different activities. And adding to this problem is the fact that the unmanaged portion of this risk is also growing. So this is insured versus uninsured losses, overall losses. And so while insurance is not the only way to manage these losses, the portion of it that's unmanaged is definitely growing. And we've seen $250 billion in recent years. Those are the estimates. So plenty of motivation, and this hasn't gone unnoticed by lots of different groups. So I'm guessing most of you are familiar with the World Economic Forum in Davos, right? The world's leaders, political leaders, captains of industry get together. And one of the things they do, I don't expect you to be able to read this right now, but one of the things they do is they rank global risks in terms of impact and likelihood. And so the really bad stuff is up there in the right-hand corner. And so for the last 6, 7 years, 8 years, these have been related to what I call environmental financial risks. So things like natural disasters, water crises, extreme weather events, and failure to mitigate or adapt to climate change. So they're not the only ones that have noticed. US government has taken more recent notice as well. In 2021, the White House issued an executive order requesting that all federal agencies declare quantify and declare their climate-related financial risks. The Federal Reserve asked the 6 largest banks in the US to come up with a report disclosing their climate-related financial risks by the middle of last summer. I don't think they've done that yet. I haven't seen that report yet, but it should be on the way. The SEC is developing climate disclosure rules for all publicly traded firms, another thing that's on the way. And some of the states have moved ahead of the federal government. This was from last fall. California actually enacted their first climate disclosure rules. So we have a tremendous amount of information. We have a demand for more information, and we have a tremendous amount of data and information being made available. The problem is that there isn't a lot of it that's been put in a form that's useful to the market participants and regulators. This is from the US Commodity Futures Trading Commission. So somebody's got to take this cacophony of data and information that's being made available and turn it into the kinds of information that's decision relevant. And so there's a lot of groups working on it, but our group is one of them. So government is certainly playing a large role here and will continue to, but I would argue that there are private sector groups out there that need actionable information in order to put us in a position to be more resilient in the face of climate change. So these are groups like reinsurers and insurers, investors, credit ratings agency, those that rate the credit worthiness of groups and thus determine the interest rates at which people borrow money. Now, these groups have increasingly, and I would say even in the last 5 years, put themselves in a position where they are now asking a lot more questions than they used to ask, and they're expecting answers. And they also increasingly are in a position to exact a penalty on those that are not responding or taking actions that mitigate some of their risk. And this is already driving some change, and I would suggest that these are forces that are going to become much, much more powerful, especially as this information begins to be processed in a way that's helpful in decision making. So there's also a market for new solutions, plenty of motivation. We see this in the popular press Lloyd's of London estimating that extreme weather losses could reach 5 trillion. Protection gap that Gallagher Reinsurance estimated at 234 billion. Use of weather derivatives is surging around the globe. So not only a demand for information, but a demand for new products, new solutions that will help us manage it. So there are opportunities out there for quantifying and managing these risks. The Financial Times called it boom times for modelers of climate change. I don't refer to what we do as modeling climate change. I think of us more as systems engineers that understand the interactions between these complex subsystems. So I'll take this moment to make a couple of definitional statements. So weather risks have been around forever, right? And I would say in a strictly definitional form, we're talking about stationary climate. Climate-related risks, here we're talking about uncertainty with respect to non-stationary weather risk. Now, when you read the term climate risk in the popular press, I'd suggest that that's the conflation of these two, right? That both of these fall under the same umbrella. I would expand things even further. We focus on what we call environmental financial risk. So that's weather, climate, and we're doing work in some other areas related to things like COVID, infectious disease, and so forth. So what do we do? CoFiRES is our cute acronym for the Center on Financial Risk and Environmental Systems. We look to identify sectors with linkages between environmental conditions and financial metrics. We model the linked natural, engineered, and economic systems to assess their vulnerabilities and interdependencies. And then we characterize the financial risk. How severe are the losses and how often are they likely to occur? And then we do two things. So originally we started out developing new financial instruments and risk management strategies to help people try and cope with these risks in a more efficient way. But increasingly, we've been finding opportunities to identify and quantify unpriced or mispriced risks out there in the market. And I think there's an increasing number of these. And there's something that there's a lot of folks trying to understand these better now. So I'll touch on a few of these as we go. So we do work in a lot of different areas of the country with application to lots of different sectors of the economy. Water usually plays a large role, but is often not the sole role. We think about extreme temperatures, we think about wind speeds. We think about water both at the dry end, droughts, as well as floods. And I was thinking about what examples would resonate best with this crowd. And given that it's a crowd, I think, mostly focused on civil and environmental engineering, I thought that the work that we've done with water utilities would be a good place to start. And then we'll move on to some other areas. So obviously, this is a huge sector, 15,000 utilities nationwide, serving 80+% of the population, mostly via surface water, 130 billion in revenues, annual revenues. Revenues and costs are vulnerable to drought. And so let me explain what I mean. We are developing new supplies at a much slower pace. This is the global pace of dam development. If you looked in the US, it falls off even more sharply. And most of these utilities that we're talking about use some form of surface water storage. And they've usually managed drought via surplus reservoir capacity, having some capacity that they don't use very often, but is there when the driest periods strike. It's becoming increasingly difficult to maintain that capacity, increasingly difficult to build the dams and to not only to finance them because they're expensive, but to go through the environmental regulatory process required to get them approved. So the question becomes, how do we manage drought now? Well, we'll still do it via the surplus capacity to some degree, but increasingly we're relying on what I would call adaptive measures. So more restrictive conservation measures during drought, and then transfers. If we're in the east, often the transfers come from a neighbor. If we're in the west, often from agriculture. And this makes sense in a lot of ways, right? I think many people would applaud increased use of conservation, right? And water transfers, with the exception of concerns over interbasin transfers, we're making more efficient use of existing resources. The challenge is that they have financial implications. So conservation will reduce your revenues, water transfers increase your costs. This happens intermittently as a result of drought and of an undefined severity, right? Or an undetermined severity, and that makes it difficult to plan for. And so The credit ratings agencies started to notice this about 10 years ago, that weather was really the primary reason that utilities were missing their financial targets. And then a few years after that, they instituted new criteria based on hydrologic variability that they were going to use in assessing in making their credit ratings. And they estimated that was going to change 25% of the rated agencies. So that's not just water utilities, but things like irrigation districts. So that's a problem. If you downgrade someone's credit, it increases their interest rate, leads to higher water prices. And to give you some sense of how sensitive these things are, these are bond interest rates for a variety of municipal bond ratings. And this comes from Moody's, one of the larger credit ratings agencies. And so if we have an excellent credit rating, let's call it AA, we enjoy a very low cost of borrowing, right? That green line there. And so if we go to A, that's still not terrible, but the interest rate goes up. BAA is not terrible. It's probably pretty low for a water utility, but for a lot of groups, it's not. But notice we make that switch, which is not unreasonable, and we're talking about a 2.5-point difference in some cases in the cost of borrowing. Now think about this from the standpoint of a utility that borrows a tremendous amount of money, right? As much as 50+% of their costs each year are debt service, debt payment. And then think about the increased costs that go along with a 2.5-point jump in the financing rate that they pay. So a significant rating downgrade can increase the utilities costs significantly. So they work very, very hard to maintain that high credit rating. And they're experiencing now threats to it that they have not seen in the past. So how do we think about managing this risk? Well, we put things in 3 buckets. So one is risk reduction, and that could be a larger reservoir, which has been one of the solutions in the past. A drought pricing scheme, you could raise the price when you're putting in place conservation measures, not necessarily popular, but you could do it. Risk retention, mostly a reserve fund. Every utility has a reserve fund. Usually, though, they end up tapping things like capital improvement budgets, which are already underfunded. So that's a challenge as well. And then there's this idea of risk transfer, which is used in a lot of economic sectors, and we'll talk about some of those later. But for utilities, this was kind of a new concept, the fact that they might transfer their risk to another party that would be better able to manage it. And so we thought about this in terms of some parametric or index-based tools, and then also in terms of risk pools. So I'll talk briefly about those. So, all right, if you're going to build an index-based insurance, you need an index. You need an index that correlates well with some financial metric of interest. And so we've got revenues here and some imaginary environmental index on the vertical axis, and a perfect index would be correlated 1-to-1, right? You would have that line. And so if you're starting to think about drought, the first inclination is to probably choose something simple, right? Like maybe cumulative rainfall or something. But we do that. It's not a very good proxy for financial risk. There's just too much that happens between when a drop of rain hits the ground and when it makes its way into some sort of productive use. So if you had a contract based on this, you get payments when you didn't need it. You wouldn't get payments when you did. They would have a high basis risk. So we spent a lot of time working with the utilities in the research triangle, several to try and develop an index, and one that was based here on stream flow and reservoir capacity and the conservation rules that they put in that were linked to reservoir storage. And the combination yielded an index that pretty well tracked with the revenues. And so we started to explore how they might use this in a layered strategy, one that might include some drought pricing and a reserve fund and some sort of risk transfer via index insurance for the really extreme events that they wanted to take off the top. And it was surprising that they were fairly receptive. They started asking where they might buy something like this, which got us to have conversations with some insurers and reinsurers and so forth. And we realized quickly that they're not going to write contracts for individual utilities, or none that are of a moderate size, right? I mean, if you're a metropolitan water district of Southern California, maybe, right, they would go to the trouble. They really want something that scales. And so we started thinking about not only scaling with an index, in this case, we use the Palmer Drought Severity Index, but something that might scale in terms of nationwide. And so before I go further, I should describe an index insurance product here, contract structure. This would be a simple index insurance, similar to a put option for those of you that spend any time in finance. And so let's imagine in this case that the index value was something like cumulative stream flow. I know I said that's too simple already, but let's assume that's it. You'd have a contract that would define a strike, which would be an index value below which you start to lose money you're concerned with. And then the payments would rise as the index continued to fall, as cumulative stream flow continued to decline. And then you'd have some agreed upon date, which might be the end of the water year, October or November. And at that point, you'd assess the index and let's say it came in at 1,200 and you get a payout of $100 or 100,000 or 100 million, however you wanted to scale it, right? So a pretty simple structure. But again, tough to come up with an index for every single utility, right? So we wanted something that scaled. And we started to think about the next question, which is how correlated are these risks? Does every utility experience drought at the same time? No, certainly not. But there is some spatial correlation, right? So different than the odds of us all having a car accident tonight, which are presumably, a totally uncorrelated event. So there's a little correlation here, and we wanted to figure out how much. So you certainly wouldn't want to write insurance contracts. There wouldn't be any value to risk pooling if all of the utilities you wrote these contracts for were in the Southwest. But if you draw the circle a little bit bigger to the entire country, then there is a lack of correlation you can take advantage of. So we took about 100 utilities that appeared to be exposed based on their financial information, which was how we chose the utilities in the first place, and looked at what they would have to hold on to individually in a reserve fund in order to protect themselves against the drought, forcing them to lose, I think it was more than 5% of their annual volumetric income. So each one was subject to the same conditions. And in order to maintain independent reserves for each of these 100, they had to sit on about $300 million. So that's for an expected loss, an expected payout each year of only 12 million. So really, what are we worried about? We're worried about the tail of that distribution, right? Really being the concern here. Well, because the risk of drought for these communities is not very well correlated, right? If we put them together, we can greatly reduce the amount of capital that you've got to sit on. Now, that has a lot of value. Right now, we've got these utilities individually sitting on an aggregate of $283 million. They've got to keep that in a very liquid form, right? Like a savings account, because it's got to be available when they need it, but you don't earn much on that. Right? So there's an opportunity cost associated with those reserves. In this case, we estimated about $13 million. Now, if they pool their risk, because they're uncorrelated risks or mostly uncorrelated risks, they're not all going to be drawing on at the same time. They can achieve the same level of risk reduction sitting on only about $100 million. And so what's that do? The expected payout is still 12 million. But because they're not all going to experience these losses at the same time, there's a big savings there. And the opportunity cost of reserves go down by about 60%. So let's think about why that's important. So think about the premiums that you pay on anything. So the premium, the first thing you've got to consider is the expected payout, right? The insurance company wants to know what are the odds that you're going to experience this and they're going to have to give you money, right? So that's important. In this case, the expected payout was 12 million. But the loading, there are a lot of things that go into loading, but one of the big things is the cost of liquidity, the cost of keeping this cash in a very liquid form. If we can reduce that by 60%, we can reduce that loading substantially. And really, it's the loading that's the cost of risk management, right? Statistically, you're going to get the expected payout back, right? But it's the loading that ends up being that ends up being costly. So this is something that we've been batting around with a couple of different groups, and I think it might have some potential. So we'll see where it goes. All right. So talked about water utilities. Let's talk a little bit about some work we've done on energy. This is also a huge industry, 500 billion in annual revenues, about a quarter of generation now nationwide, depends on environmental conditions, hydro as well as solar and wind. And the demand is highly dependent on temperature. So to give you just a sense here, right, you guys already got this from the earlier example, but generation and stream flow, right, are fairly well correlated. At the same time, temperature and demand are highly correlated, right? We see extreme cold, extreme heat, demand goes way up. That can be good to a point. Utilities are selling more power and there's an advantage to it, but beyond some point, they have to draw on really expensive resources that end up costing them money. So it's a fine line. Now, the challenge is that drought and heat waves are often correlated. So we've got compound risk we've got to deal with. And recent research suggests that the level of correlation between droughts and heat waves is going to increase over time. So that puts these utilities in a dangerous position. So we did some work on Pacific Gas and Electric in California. I did this work with Jordan Kern's group over at NC State. And to understand some of the risk here, it's important to look at the generation mix. So nuclear provides most of the base load. But we've got a significant portion of the portfolio that's subject to natural variability. Renewables on a very short time frame bouncing around, but most of that, when you've got hydro, can be compensated for relatively easily, right? Hydro is easy to turn on and off. When hydro is not available, though, it's fossil fuel, mostly natural gas-based generation that compensates for that. Now that puts them at risk two ways. One is natural gas-based generation is more expensive than the renewables. So if they've got to use more of it, their costs are going to go up. Two, you're subject to the risk of high natural gas prices, which vary a lot. So that can compound your risk. So PG&E has gotten some real life lessons in this as a result of the drought from 2012 to 2016, where they and their two largest competitors, not competitors, but their two largest comrades, the other two large investor-owned utilities in California, lost about $2 billion as a result of lost hydro. They lost almost $4 billion as a result of high temperatures, these extreme temperatures. So they know this is a problem. So there's some solutions here, some solutions that exist right now. You can buy natural gas futures and lock in prices in advance to protect yourself against that. Hydrologic index insurance, it's not all that common yet, but it's still available. And that can protect you against the impacts of drought. And then weather derivatives, heating degree days and cooling degree days. In this case, in California, it's mostly concerns over extreme heat, so the amount of energy used for cooling. So all three of these can be assembled into a joint portfolio, and this is in fact what many utilities do. The challenge is that individually, they don't account for cross-correlation between conditions, right? And it's these compound risks, these correlated events that really present the worst outcomes. So we explored this further with Kapow. This is a model that Yufei Su was the primary designer and did a lot of work with Jordan on it. The California and West Coast power systems model, I won't go into this in detail, but we take a lot of historical weather data, use that to design a synthetic weather generator that gives us all this hydrometeorological input or output that then we can turn into generation of wind, solar, imports and exports coming from Pacific Northwest, which is also part of the model, and the hydrologic mass balance turns hydropower into generation there. Then we make up the rest with thermal generation. So with the natural gas and the nuclear. And so it validates incredibly well. And so we can look at how much power is coming from each source at what time. And we can also estimate with fairly high fidelity wholesale electricity prices in the CAISO market. So adding to that, we put together a financial model at PG&E. So they generate and sell water or sell power into the wholesale market. They also buy out of the wholesale market. So that combined with an understanding of how they retail to the different portions of their customer base gives us an understanding of their net revenues and how they fluctuate as a result of all of this. So once we have that information, we can look at how net revenues are affected by stream flow. Fairly weak relationship with hydropower. It's a relatively small portion of their portfolio, but an important part. So we see that with higher stream flow, they earn a little bit more revenue. CDDs, this is a measure essentially of heat and the amount of energy used to cool. We see that goes up for the most part as a result of selling more electricity. And then natural gas. We see that has natural gas prices as they rise have a big impact on the net revenues associated with PG&E. So we can build a portfolio of these independent contracts, and we did. I tried to build a minimum cost portfolio that met a certain risk management standard. And then we compared it with our contract that was based on the composite index, which takes into account the cross correlation between these. And what we found, and this is one way of representing it, is that the composite index contract was much more effective. So if you look at losses, which are the dotted lines below the zero axis there, we see that the orange bars, right, being the payouts from the composite contract, match up very well in terms of timing and magnitude with the losses. And there's some of that there with the individual contracts, but the thing you see is there's very large basis risk, meaning there's a bunch of payments that are made when you don't need them. And that makes these contracts, this portfolio, much more expensive. In fact, the basis risk leads to a contract with the composite index being about half the price of the portfolio. And so we think that this has a lot of potential as well. This is a paper that's in review with Earth's Future. It's based on Corey Pahel's master's work, but Yasha Molkar, a PhD postdoc working with us, has pushed it over the finish line right now, or at least the submission. All right, so let's move to the other side of the spectrum. We've talked a lot about situations in which there's not enough water. Now let's talk a little bit about situations in which there's too much water. So flooding, tropical storms, extreme events are not uncommon in the Gulf Coast or along the mid-Atlantic coast in North Carolina. And that's given rise to concerns over the impacts that flooding might have on mortgage defaults. Could push people that experience these losses into default. They're not able to make good on their mortgage. And so in North Carolina, what we've seen, and we've spent a lot of time on this, is that a flood does a few things. One is that uninsured people will end up borrowing against the value of their home's equity in order to recover from flood events. At the same time, property values often decrease, not only at flooded properties, but at unflooded properties in close proximity. That reduces the amount of equity you have to borrow against, which is a problem, right? So a lot of it comes down to tracking what they call a loan to value ratio. So loan to value ratio is the amount that you owe, that you've borrowed, over the value of the property itself, right? So if you buy a property with 20% down at the beginning, right, the loan should be about 80% of the property's value, and you would have an LTV of around 80, right? And then as you pay the mortgage off, that number goes down. The problem with a flood, well, the challenge is when it goes above 100, right? When it goes above 100, that means you owe more on the property than the property is worth. And that's when you start to see people default on their mortgages. In this case, we've used 90-day delinquency rates on mortgage payments as a proxy, but that's usually a pretty good sign that someone's going to default. So what a flood does is it affects both the numerator and the denominator. So people borrow to finance flood repair. So they increase the flood size, or the numerator, increase the amount of debt that they have. At the same time, flooding often depresses property values. So the denominator goes down. So you can easily see properties that are in the 60, 70, 80 LTV range go over 100. And that's when people start to walk away, right? So debt greater than property value, increased likelihood of mortgage default, people walking away. Property owners lose equity. And so that was an interesting endpoint that we wanted to explore. But the other is that the lenders who end up taking ownership of the property lose the repair and resale costs, which is not inconsequential either. So they're concerned about these sort of risks as well. Now, in some cases, the damages are so bad that abandonment follows default. And that's a situation in which damage actually exceeds the property value. And at that point, nobody wants it, right? And so we really see increased likelihood of abandonment. In that case, the lenders lose any unpaid mortgage balance. So they're on the hook for that. And local governments begin to get involved because they're responsible for either demolition or maintaining these properties. And this is what we saw in Katrina. New Orleans government, local government had to cover these costs, and it ran to the order of $400 million. So it wasn't inexpensive. So in order to answer these questions, we need a lot of data, and we needed it at the parcel scale, right? At the level of the individual properties. And so we were really lucky to convince NFIP, the National Flood Insurance Program, and FEMA to give us address level information on flood policies and claims, which was really good for ground truthing things, right? Otherwise, you're making a lot of estimates, but that was really valuable. We also need property sales data to understand how property values vary before and after these events. And we need mortgage information, which we can get. You'd be surprised at what sort of consumer information you can get at the address level if you're willing to pay a little bit for it. So it's a little scary. So mortgage information plus property value, then we can assess home equity, so the ability to borrow against. So what we have is relatively sparse financial data, right? We've got properties with data and we've got properties without data, and we need to fill in this picture to understand what the risks are. And so we use some machine learning and some spatial interpolation to assess uninsured damages, which are hard to figure out. Insured damages are easy because everybody makes a claim, right? And that data is all available. Uninsured damages are tough to figure out. Property values at unsold locations are also tough to figure out. You can't use property tax estimates. Those lag and they're inaccurate. You actually need sales data. And then we use that to compute some mortgage balance and home equity information at the individual properties. So this wasn't easy, but when you get it all put together, you got observed and simulated financial data that you merge together that can help you make some better assessments. So estimating uninsured damages with a machine learning approach, a random forest model. We start out with information, hard data, right? We know which homes with policies filed claims and which ones didn't. So we know who flooded and who didn't. Then we use a number of predictor variables, both related to the environment, distance to water body, percent impervious cover, location in and out of the special flood hazard area, the 100-year floodplain effectively, and information on the properties, first floor elevation, square footage, foundation type, construction date, and so forth. And without going into too much detail here, we can turn this into a continuous prediction of flood extent and the amount of damage that occurs as a result. So we've got all that information, but now we need to understand property values. So we used a hedonic approach, probably not dissimilar to what is used by Zillow, Redfin, and groups like that. So we know something about some of these homes in terms of bedrooms, bathrooms, square footage, construction date, and we have sales data on some of these properties. And we can use that to estimate values in properties where we have no sales information. But that's not enough to tell the story. There's also things that don't show up as attributes for the individual homes, things like school districts and parks and amenities and things like that. But by kriging, by looking at the influence of proximity to known property values, we can add some of that nuance to these property value estimates. All right, so we applied this to a lot of storms. I'm just going to talk about Hurricane Florence here, which was one of the more serious events. We had 30 or 40 inches drop on eastern North Carolina in a series of days. And so that caused some extreme flooding. In this part of the state, we've got a lot of shoreline, extensive river and stream networks. It's largely rural, except for the coastal areas, and it's hit by a lot of hurricanes, tropical storms. So in Florence, we had almost 80,000 structures damaged. We had about 350 million in insured damages, which again, we got pretty good estimates of that. And there were a number of estimates of uninsured damages that came about that mostly averaged around 70% of the total damage was uninsured. So we looked at insured damage and we came up with a pretty similar estimate, about 370 million. But when we looked at uninsured damage, yeah, we found that was the lion's share that was experienced. So over $1 billion. And then our estimate was also something that hadn't been estimated before, which is what sort of property value loss did these homes experience as a result of this event? So when you put it all together, we're talking about over 2 billion in financial losses in aggregate. So, and we can track these spatially. Actually, we can trace them down to the individual home level in many cases, but this is aggregated up to the census tract level. Those areas in which we experience both uninsured damages, high uninsured damages, and large decreases in property value are there in the darkest shades. So what that let us do then was assess the financial risk. Essentially, how many homes are crossing over that threshold, either LTV going over 1, so a real risk of default, or put in a position where the damages actually exceed the value of the home. And so then we can trace that to the affected party. So property owners still experience the vast majority of the loss, maybe most of it in terms of lost equity in the home. But lenders are on the hook for 150, 175 million here in potential losses in terms of equity or repair and resale costs. And then local governments are also under a lot of stress from at least $100+ million in losses associated with having to take care of these abandoned properties. And so I'll just give you 2 examples to give you an idea of how this affects different areas. So New Hanover County is a coastal county down there, relatively wealthy. An annual budget for the county of about 300 million, a mean household income of about 56,000. Robeson County, in more to the interior, has a county budget of about a third of New Hanover and a mean household income that's only about 60%. So if you start to look at the impacts, the relative impacts for risks that are similar, right? Both experience a similar level of risk, but it manifests very differently, at least beyond property owners. In both cases, property owners are on the hook for 50 to 60% in terms of loss equity. But in the more wealthy county, where mortgages make up a more substantial portion of the overall debt, right? The lenders are on the hook for a lot more of it, and local governments for a much smaller percentage. Now, that has a lot of implications when that shifts, when we go to these poorer counties where the municipal governments have fewer resources to work with and yet are subject to much greater risks related to abandonment. And so they are not well positioned then to manage these risks. So again, lenders in wealthier areas, you see more of it accruing to lenders. Local governments hold more of the risk when it comes to the lower, less wealthy areas. So how can we use this information? So we can use it to target resilience investments. So identify where to incentivize flood insurance purchases. The state is actually thinking about perhaps subsidizing some of that, right? Both to help out and because it probably passes some of that risk on to the federal government. Spatially informed buyout programs and community development strategies. And we can also use this information to try and identify low-value properties in rural areas that would be in need of federal and/or state assistance. So the place we want to take this next is looking at the impacts on secondary mortgage markets. So these mortgage-backed securities, right? People package up lots of mortgages and sell them as a security. And so in the residential sector, that's one of the largest markets in the world. Almost $8 trillion worth of mortgage-backed securities are traded. They mostly originate with what are called the government-sponsored entities, Fannie Mae, Freddie Mac, and Ginnie Mae. Now, these securities, the principal and interest are guaranteed by the GSEs. So if there's unpriced or mispriced risk there, and these were to default, we're all on the hook for that, right? Taxpayers. On the other hand, there's commercial mortgage-backed securities, which is still a large market, 1.5 trillion. But these are issued mostly by investment banks, and they are not guaranteed. So it's investors that are actually at risk here. And so we hypothesize that there is significant potential for unpriced or mispriced flood risk in both of these markets. So it'd be interesting to know how much of that accrues to the GSEs and thus to all of us, taxpayers, and also interested to how much of these potential costs of default would accrue to investors on the commercial mortgage-backed security side. So the last thing, and I won't go through much in terms of results here, but we've done a lot of work on inland navigation in the Mississippi Basin and the Great Lakes. These inland waterways are the means by which a tremendous amount of bulk cargo makes its way to market. They're relatively inexpensive compared to rail and truck, also less environmentally damaging. So a lot of cargo makes its way through these waterways. The challenge is that low water levels begins to impact their ability to bring these goods to market. If you're in the Great Lakes and water levels drop, you have trouble getting the goods into the shallow harbors or through the shallow locks that are so important. If you're in the Mississippi, low water levels translate into impairment of barge traffic and can even shut things down from time to time. And this is actually from a year ago. Actually, they've experienced low water levels this year also, or last fall, so 2023 as well. So we did a lot of work in the Great Lakes. I did some work with Casey Brown over at UMass Amherst. Variable water levels, they vary relatively slow, but there's not much you're going to do about it when they do vary. And so you're at risk. This is a cartoonish depiction of the problem. So if you've got normal water levels, the ships can carry maximum cargo, maximum capacity, and still maintain what's called the minimum under keel clearance. So the Coast Guard mandates this even for inland waterways because they don't want these ships running aground and screwing up traffic patterns for everybody else, right? So when water levels drop, what happens is they still have to maintain minimum under keel clearance. The only way to do it is by reducing the amount of cargo that they carry and reducing their draft. And so less cargo means either less revenue or you got to raise the prices because your costs remain relatively fixed. So you got one of those two choices. Neither of them are favorable. One impacts the people that contract with you. The other impacts you. So, and we see a little bit of difference depending on whether we're in the Mississippi or whether we're in the Great Lakes. So Elliot Meyer, this is from some of his PhD work. We developed some index insurance that demonstrated that we could significantly reduce risks in in Great Lakes shipping. We looked at how this would be impacted by climate change, especially if we had long-term contracts, how the insurers would deal with it. And then importantly here, the other solution, of course, to having low water levels and maintaining inland navigation is dredging. But that's a really dirty and really expensive business. And so we did some work trying to think about how we would optimally integrate hedging and dredging as two parts of the same. And we found that there were a significant number of times in which hedging made much more sense, reduce at least the volume and presumably the cost associated with dredging. So in the Mississippi, we've done a lot of work. As a matter of fact, this is with my colleague Lincoln Pratson at Duke. We just submitted a paper today, or I would have had the results up here already. But what we saw was, I showed you that picture already from a year ago where we had low water levels. Mississippi barge rates spiked as a result. So that's very costly. And so we were interested in how barge rates respond to water levels. And we actually had 3 droughts that we could track it through because transport costs are a significant portion of the overall cost of many bulk commodities, right? Corn or soybeans, things like that are actually relatively inexpensive. Getting them to market is a significant part of the overall price. And so we're interested in how commodity prices for corn and soybeans respond to low water levels. And they actually respond in a very direct manner. And so we also believe that some of the hydrologic information that's available is not fully incorporated into things like the forward prices. So there may be some mispriced risk there that we're exploring. This is a problem all over the globe. The Rhine experiences these same sorts of threats. Panama Canal is a recent example. Everyone thinks that you dug the trench and then filled in with seawater. No, it's all fresh water coming from Lake Gatun up there that fills the Panama Canal. And so when water levels drop, levels in the Panama Canal drop, and that's what's impaired traffic through there, which is right a critical conduit for commerce globally. And then as recently as 6 months ago, drought in the Amazon reduced flows and disrupted the movement of grain exports. All right, so there's lots of other things that we work on. If anybody's curious about any of these projects, feel free, or we have a website where you can look at all these. I'm excited about the work we're doing, looking at infectious disease and healthcare facilities, but we won't chat about that now. I'll make the case that by managing financial risk more effectively, certainly there's a financial benefit, but also we've seen that there are ways of managing risk that encourage greater conservation efforts and more efficient resource use. They can help us reduce our reliance on physical infrastructure, help us increase our use of renewable energy, and engage in fewer environmentally damaging actions in the cases that I've given you dredging. So we're lucky to have had funding from a lot of groups, continue to enjoy the benefits of projects that were supported by many of these organizations. And then I'll stop with pictures of all the people that actually do all the real work. So thank you.
Thank you, Greg. I think we might have time for a few questions before the Tufts folks come barging in and kick us out. So does anyone want to kick off? Question for Greg? Sure. Miguel?
Yeah, so a couple times you showed variations of the graph, which was uninsured revenues versus insured revenues. And we saw how the insured revenues were lower at the most lucrative years, but also higher at the riskiest years. If you were to sort of take the area between those curves, how does it net out? Like, what is the overall cost of that?
Yeah, you're never getting insurance for free, right?
Yeah.
And so if you're thinking about the figure that we showed for the Great Lakes, right? If you want to protect yourself against only the worst 5% of losses, right? It costs you about 0.7% of average revenues. If you wanted to protect yourself against the worst 90%, then it rose to about 2.5%. If you wanted to protect yourself against the worst 85, right? So now you're getting payouts a lot of times, right? I think it rose to like 6.5%, 7% of average revenue. So depends on the level at which you want to protect yourself. But yeah, it's risk management isn't free, right? It's always going to cost you something. So, and that trade-off, that's why for really frequent events, less severe events, you're going to rely on things like a reserve fund, right? Or other things that'll be a less expensive. Usually for when we're talking about risk transfer, it makes sense for more extreme events, right? Low frequency, high consequence events is usually where that comes into play.
So a question in the front.
Sure, I was wondering if you could use any of these models to make decisions about alternate technologies, like for water reuse, converting wastewater to freshwater or desalination, things like that.
So that's why we break things up into the natural system, the engineered system, and the economic and financial systems. Because if we understand how all these systems operate, it's much easier for us to go in and say, you know what, we're going to change something in this engineered system, as opposed to a purely statistical approach. So the idea that AI is going to take over the assessment of all of these risks is one that's very prevalent in the insurance business right now. I would argue that you need to understand the system first, right? Because you never have coincident time series for 50 or 60 years of revenues, water storage, and inflows or something like that at the AI program. So I think the advantage of the way that we put things is it's easy to modify based on a change in technology, a change in environmental rules, a change in hydrology, right? We can modify any of those and look at how that cascades through to impact financial risk.
Paul?
Yeah, I have a question. There's a great deal of interest on social justice and equity now. And one of your slides, you sort of implied that in certain cases, one of the towns that had lower expenditures, annual expenditures, had suffered most. Have you done anything explicitly to look at this issue of among population, among residents, who bears the greatest financial risk?
It is, and if I'd had time, we were going too long already. I didn't want to show. We actually stratified by property value and looked at the lowest quintile. That's where most of the risk resides. But it's almost evenly distributed between the loss of home equity and the payments or the potential losses of the municipal government, because it's mostly abandoned properties at that point. Lenders don't experience much risk. If you go up to the more highly valued properties, that's where the lenders start to lose money, right? But lower levels of risk overall, because in general, their loan to value ratio is small, right?
Yeah, but if you look at the factor their income in, it might hurt them even more though.
So, right. So property value is not income, it's not household income, but we do have that data now. And there's a really strong correlation between household income and property value. And so, yeah, there might be some subtle differences, but I wouldn't anticipate that they were very large.
George?
How do you encourage greater financial investment from financial institutions, even in the face of better quantified risk?
I mean, I think that an increasing number of large investors, I'm talking about institutional investors, that become aware that there is unpriced or mispriced risk when it comes to weather and climate. And I made this point earlier with the students that we were at. They used to get free passes on this. And I'm talking about senior management of many companies, right? They would lose $200 million and it would be like, well, that was force majeure, right? Nobody could predict, but it was a drought, it was a flood, it was whatever. Now, because of concerns over climate risk, and I'm not saying that many of these events are climate related, many of them existed anyway. They're being asked a lot more questions than they used to be, right? And they better have answers. If they don't, there's now a penalty that can be exacted on them, right? By the groups we're talking about, insurers or reinsurers, investors, credit ratings agencies. So it's not everybody yet, but I am seeing that this effect is there. And I think it's going to become increasingly impactful as more and more information is made available and turned into something that they can use in their decisions. But I think there's more information available than there is useful information right now. And so that's where I think a lot of the challenges lie. Yeah.
So how many of your students have gotten out of the academic side and gone over to make the big dollars from those gaps between knowledge-based risk and unrealized risk?
A large fraction of my students go to work in what would probably be considered non-traditional areas for most of environmental engineering. I do put a few in consulting firms, and I do put a few in academia, but I've put a number in reinsurance companies, large groups like Standard & Poor's, McKinsey, but they didn't last long there. They didn't like it. They said they just made PowerPoints. I've had a couple of them that have gone on to very entrepreneurial ventures that we could talk about. We probably don't have time here. And one that just recently took a position as lead climate analyst for Oliver Wyman, which is a group that does a lot of consulting and analytics for insurance companies.
Interesting.
And yeah, I think they don't tell me exactly how much they make, but I think they make a lot.
Let the alumni office know about those folks.
I'm hoping they think fondly back on their experience and come back, and before I retire, they can endow some sort of fun beer drinking event or something.
Any last questions for Greg?
Yeah, would you characterize the general awareness as being highest in those, you know, the financial and the insurance industries, or what about the utilities that you were talking about?
The utilities,
Is it
definitely,
on
the
there?
power utilities are definitely very aware of it, and so are the water utilities. Power utilities probably even more so, because they're in a more competitive field. I mean, by that, I don't mean in a bad sense with respect to water utilities, but you know, power utilities are competing within markets, and so they're very aware that these sorts of things represent a potential vulnerability. Do I think that the reinsurers and the investors and the credit ratings agency, I think that their awareness is growing fastest because they have the most incentive to begin to make better decisions there.
Let's thank Greg again for thank you for coming to Tufts.
And if anybody's got any other questions, please feel free or send me an email. If you can even get close to my last name and put UNC, Google will find me.